Most people believe crashes are like gravity. When something goes wrong, everything falls at the same time. Stocks, businesses, jobs, confidence, all collapsing together in one violent move. That belief feels logical, especially when headlines are loud and fear is everywhere. But it's also one of the most expensive misunderstandings in modern finance. Because history doesn't show everything falling. It shows something more uncomfortable. While panic spreads and people rush to protect themselves, certain markets quietly keep working, keep earning, and sometimes even strengthen. The real danger isn't the crash itself, it's assuming there's nowhere safe to stand. This matters right now because uncertainty isn't coming from just one direction. Inflation concerns, debt levels, geopolitical tension, and shifting technology have created a background noise of anxiety that never really turns off. When people live in that environment long enough, they start making decisions driven by emotion instead of logic. They sell what they don't understand. They hold cash because it feels safe. They wait for clarity that never fully arrives. And in doing so, they often abandon the very areas that historically survive chaos. The idea that some markets don't crash sounds almost offensive when fear is high. It can feel unrealistic or even irresponsible. But survival doesn't mean prices never move down. It means the underlying demand, incentives, and usefulness don't disappear. It means cash flow continues, behavior stays consistent, and human needs don't suddenly change because markets are volatile. When you look at crises through that lens, patterns begin to repeat themselves in a way that's hard to ignore. One of the biggest mistakes people make is treating markets as numbers on a screen instead of reflections of behavior. Prices move because people act. People act because of incentives. And incentives don't vanish just because confidence drops. In fact, during stress, incentives often become stronger and clearer. The key is identifying which parts of the economy are built around optional behavior and which are built around necessity. When fear spikes, spending does change, but it doesn't stop. It shifts. People delay upgrades. They avoid luxury. They postpone wants. But they still need certain things to function day to day. They still pay for essentials. They still rely on systems that make modern life work. Markets tied to those realities behave very differently from markets built on optimism and excess. Think about what happens during uncertainty. Businesses cut back on expansion, but they don't stop operating. Households adjust budgets, but they don't shut off daily life. Governments may argue and delay, but they continue spending on core functions. That baseline activity creates stability in places most people overlook because they're not exciting during good times. One of the most resilient areas historically is anything connected to basic human consumption that doesn't depend on mood. Food doesn't become optional in a downturn. Energy doesn't become optional. Utilities don't become optional. The form may change slightly, but the demand remains. People may eat out less, but they still buy groceries. They may travel less, but they still heat their homes and charge their devices. They may cancel subscriptions, but they don't stop consuming electricity or water. What's interesting is that these areas often underperform during boom periods. They're considered boring. They don't promise explosive growth or exciting stories. Because of that, many investors ignore them until stress arrives. Then suddenly, stability looks attractive, cash flow looks valuable, predictability looks comforting, and money starts flowing toward what still works instead of what once sounded exciting. Another area that consistently shows resilience is anything tied to maintenance rather than expansion. When times are good, people upgrade. When times are uncertain, they maintain. They fix instead of replace. They repair instead of redesign. That shift benefits businesses and markets that focus on keeping existing systems running rather than building new ones. Infrastructure maintenance, basic manufacturing inputs, and essential services often fall into this category. This is where misunderstanding causes costly behavior. People assume a slowdown means less opportunity everywhere. In reality, it often means opportunity moves. The companies and sectors built for efficiency, reliability, and continuity don't need optimism to survive. They need usage, and usage remains. Healthcare is another example that reveals how incentives override fear. People don't stop getting sick because markets fall. They don't stop needing medication, treatment, diagnostics, or care. In some cases, stress and uncertainty actually increase demand. While individual companies may face challenges, the overall need doesn't disappear. That creates a level of insulation from pure economic cycles that many other industries don't have. The same logic applies to insurance. When risk feels higher, protection becomes more valuable, not less. People may complain about costs, but they're less willing to go without coverage when uncertainty rises. That behavioral response supports stability in areas designed around risk management rather than growth optimism. Another misunderstood survivor during crises is anything tied to replacement cycles rather than discretionary upgrades. Certain equipment, tools, and services wear out regardless of economic conditions. Vehicles need maintenance, systems need replacement parts. Software that runs operations still needs support. Businesses may delay expansion, but they don't shut down what keeps them functional. This is why some markets quietly hold value even when headlines suggest everything is falling apart. The difference isn't intelligence or insider knowledge, it's understanding behavior. When you stop asking, what will grow fastest, and start asking, what cannot be avoided, the picture changes. There's also a psychological layer that keeps these markets resilient. During fear, people crave certainty. Predictable outcomes reduce stress. Markets that offer steady returns, consistent dividends, or reliable income streams become emotionally attractive. Not because they're exciting, but because they reduce anxiety. That emotional preference influences capital flows more than people like to admit. One of the most damaging habits during downturns is confusing volatility with failure. A price moving down temporarily doesn't mean a market is broken. It means perception has shifted. Markets tied to real-world usage often recover not because optimism returns, but because usage never stopped. Over time, price reconnects with reality. Cash is often treated as the ultimate safe position during fear. And while short-term liquidity has value, long-term over-reliance on cash creates its own risk. Cash doesn't compound, it doesn't adapt. It quietly loses purchasing power while waiting for perfect clarity. Meanwhile, resilient markets continue operating, collecting revenue, and adjusting to conditions. The people who tend to benefit during turbulent periods aren't predicting crashes perfectly. They're positioning around durability. They accept that they can't time fear, but they can choose exposure to things that don't rely on optimism to survive. This mindset also reduces emotional mistakes. When you understand why a market exists and what behavior supports it, short-term price movement becomes less threatening. You're not holding something because you hope others will buy it later at a higher price. You're holding it because it serves a purpose that continues regardless of sentiment. Compounding works best in environments where time is allowed to do its job. Markets that survive stress provide that time. They don't require perfect entry points or constant monitoring. They reward patience more than prediction. Another overlooked factor is how institutions behave during uncertainty. Large pools of capital don't panic the same way individuals do. They rotate. They reallocate. They reduce exposure to fragile areas and increase exposure to durable ones. That movement reinforces resilience in certain markets because it's driven by mandates, risk management, and long-term obligations rather than emotion. This doesn't mean these markets never experience declines. It means their declines are often shallower, shorter, and more recoverable. And for long-term participants, that difference compounds into meaningful outcomes over time. What often hurts people most is not the crash itself, but abandoning strategy in the middle of it. Selling durable assets to chase perceived safety often locks in losses and misses recovery. Meanwhile, the markets that were designed to endure continue doing exactly what they've always done. It's also important to understand that resilience doesn't always look dramatic. Sometimes it looks boring. It looks like modest returns when others are swinging wildly. It looks like slow progress while others are hoping for rebounds. But boring has a powerful advantage. It's easier to stick with, and consistency beats intensity over long periods. Opportunity cost is rarely discussed during fear, but it matters. Every decision to exit a resilient market is also a decision to sit somewhere else. Often that somewhere else offers comfort but little growth. Over years, that trade-off becomes expensive. Another principle that shows up repeatedly is pricing power. Markets that can adjust prices without destroying demand tend to survive stress better. If costs rise, they can pass some of it through. If conditions tighten, they can adapt. That flexibility is a form of resilience that doesn't depend on economic forecasts. This is why understanding incentives is more useful than predicting outcomes. Incentives drive behavior. Behavior drives demand. Demand supports markets. When you align with incentives that don't disappear during fear, you reduce the need to guess what happens next. Patience becomes a competitive advantage during chaos. Most people feel pressure to act. Doing nothing feels irresponsible, but sometimes the most disciplined choice is staying aligned with what continues to work while others react emotionally. This approach also changes how you consume information. Instead of chasing every headline, you focus on fundamentals of behavior. Are people still using this? Are businesses still relying on this? Are governments still funding this? Those questions provide more clarity than predictions ever will. It's also worth acknowledging that no market is immune to poor management or structural change. Resilience isn't a guarantee, it's a probability. But stacking probabilities in your favor matters more than chasing certainty that doesn't exist. Long-term wealth building has never been about avoiding downturns completely. It's about navigating them without self-sabotage. Understanding which markets historically hold up under pressure helps remove fear from the equation. The biggest advantage of this perspective is psychological. When you expect volatility but trust durability, you're less likely to make inefficient choices. You're less likely to panic sell. You're more likely to stay consistent. And consistency is what turns time into results. Crashes reveal behavior. They expose which markets were built on speculation and which were built on necessity. They punish leverage and reward patience. They don't end opportunity. They redistribute it. If there's one lesson history repeats, it's that panic is expensive. Not because fear is irrational, but because acting on it without understanding incentives leads to decisions that feel safe short-term and harmful long-term. The goal isn't to be fearless, it's to be informed. To recognize that while headlines talk about everything collapsing, reality is more selective. Some areas bend, some areas break, some areas quietly keep going. When you align yourself with what continues to function during stress, you give yourself something most people don't have during uncertainty. Time. And time, combined with discipline, is one of the few advantages that compounds regardless of market conditions. As uncertainty continues to come and go, remember that survival isn't about predicting the next crisis. It's about understanding human behavior during one. Markets that serve non-negotiable needs don't disappear when confidence drops. They adapt, endure, and often emerge stronger. Long-term thinking isn't exciting, but it's effective. And effective strategies don't need perfect conditions. They need patience, clarity, and the ability to stay grounded when others lose perspective. If this perspective helped you think differently about risk, resilience, and long-term decision-making, support the channel by liking the video, sharing your thoughts in the comments, and subscribing for more calm, logic-driven financial documentaries that focus on discipline over hype.